Hi there, welcome to the first episode of the Kingstone Podcast. My name is Marcus Hawkins and I'm the Chief Technology Officer. We're also joined by the Chief Investment Officer, Ethan Gosh, and we have a very special guest, Alex Dryden, who has a wealth of experience in markets and will be talking to us about a potential AI market bubble, sovereign AI, and more.
I'll start off brief introduction for my background for anyone that's sort of listening and for Ethan's benefit. I was a senior economist at JP Morgan for about a decade. I then 3 years ago, I'll cut a long story short, burnt out, left the industry, decided to go into academia, pursue my PhD in economics. But as is the nature of finance, just when you think you get out, it pulls you back in. And what you end up doing is sort of getting stuck into various projects and side hustles. So a lot of my work now, alongside what is meant to be my primary work, which is my PhD in academic work, is I do a lot of market commentary, still appear in the media, still do sort of weekly notes for people, and still do a lot of economic advisory work for clients, just talking about financial markets. And it helps keep my eye in. I quite enjoy it, make sure that I don't sort of drift off into academic oblivion, if that makes sense. But fair enough, Marcus. Do you want to ask the questions, and I'll take a pop up trying to make sense of this particularly chaotic market?
Absolutely. I just wanted to start off with. So we discussed in the past how investors can participate in the AI markets craze without having as much risk, namely with equal weighted indices. We talked about equal weighted S&P 500 index, and at a time when the S&P 500 is becoming more and more concentrated with few mega tech corporations, 40% exposure to one technological ecosystem. How can investors gain while ensuring low volatility? And is it even possible?
Is it even possible? Look, I think this is where the challenge is. The market that we're witnessing right now is, and there's a good chart that I can circulate to you guys, but Marcus, I'm sure you've probably seen it, which is the sort of market cap weighted S&P 500 versus equal weighted S&P 500. And over the long term, equal weighted stocks tend to outperform their market cap weighted peers. So if we're looking at any real length of holding period, typically 3, 5, 10, anything that's lengthy, you will see equal weighted typically outperform market cap. It does a better job of capturing the rising stars, does a better job of avoiding the bubbles, and so over the long term typically outperforms. What we're witnessing at the moment, though, is significant outperformance of market cap versus equal weighted. And that has been the case for the last couple of years as effectively this AI tech disruptor bubble, whatever term you'd like to use, keeps expanding. When that happens, we've seen it happen twice in history before. Once was the dot-com era, and the other was the Nifty 50. Both of them ended in tears. If you don't know the Nifty 50, go back for your economic history textbooks. Take a look at the 1970s. Very similar dynamics to what we're seeing now. Everybody's very quick to compare to the dot-com, but the Nifty 50 isn't too far behind. And what ends up happening is once the bubble pops, market cap underperforms for quite a prolonged period of time as the euphoria leaks out of that asset bubble. Now, in my mind, one of the bits of advice that I've said to people with this AI bubble is moving into equal weight makes sense. Why does it make sense? Well, one of two things is going to happen. Either this AI bubble pops, in which case market cap's going to underperform, equal weight's going to have some protection because you're naturally shielded against some of these very expensive names that dominating the top 10 of the index. The other way it could win is that the AI trade comes good, right? For the next leg of this AI rally to make sense, these valuations need to be justified. The only way to justify them would be for equal weighted to outperform, because the benefits of AI begin to show up on non-tech balance sheets. Does that make sense? And that triggers like another earnings wave that justifies the valuation, and hallelujah, the AI bubble comes good. Does that make sense? That's how you can do it. The thing about it, though, chaps, is you'll find as you get closer to managing the money, the pressures and decision making begins to change. You can probably see from this, the logical thing is to go with the equal weighted index. But this bubble has been inflating for a long period of time now. And by doing that, you're sacrificing upside. And that can potentially mean if you're managing a fund, you're going to start lagging your peer group. You're going to start lagging your benchmark because you're underweight these very narrow number of names that are rallying really hard. And what happens next? Assets begin to leak away. Clients start calling you in a pretty bad mood because you're underperforming. And so I think whilst it's theoretically possible for many investors, it is practically difficult and very painful to lean against this. So that is the way to do it, at least within your US equity exposure. One of the things we haven't talked about is how this is spread to other parts of the investment universe. My worry with AI is that it's very different in terms of how far it is spread than some of the previous bubbles. Many of the previous bubbles, it's been concentrated, like the dot-com era, was concentrated in US equities, in a handful of names. It didn't really go international, or at least not to the same scale. There was a bit in Japan, sure, but it wasn't to the same scale. What I worry about now is that when I look at AI, I find it hard to find places to survive and to hide. It's in private credit. It's in private equity. 50% of the emerging market benchmark is tech and semiconductors now. You're lacking in diversification benefits, which means that like just doing equal weight probably isn't enough. If you're looking at a holistic portfolio, you want to be looking at cash. You want to be looking at some corporate bonds to try and offset some of this. That's the only way to achieve that lower volatility outcome, Marcus, that you're sort of pointing to in my mind.
Okay, absolutely.
Kind of leading on from the AI bubble question. We've obviously recently had Walsh's first Fed meeting, and he kind of shocked markets by being a bit more hawkish than they were expecting. And we're kind of starting to see some like mixed signals emerge for these AI trades. Like OpenAI is talking about delaying their IPO to 2027 because of kind of unstable markets.
Sure.
So do you think a hawkish Fed could be the thing that pushes it over the edge and finally pops this AI bubble? Because, I mean, their valuations are particularly sensitive to interest rates because all of their predicted earnings are in the future, right?
So I like this question. You're the second or third person in the last week to ask me about it. So what I might do is shamelessly steal it, Ethan, and turn it into a weekly post for my Financial Fables blog. So what bubbles come to an end for lots of different reasons. Okay, like there are but with that being said, there are usually some similar characteristics around them. One is that valuations just get too frothy. The second is that the Federal Reserve hike and pop the thing. Or the third is that effectively it implodes under its own weight. Okay, they're the sort of three ways this thing typically ends. Now, let's sort of try and apply that to what we're seeing right now. With regards to valuations, markets seem to have lost their freaking mind about how to value stocks. And like I'm sure we'll talk about SpaceX momentarily, but I point to SpaceX as a prime example. This company does not make sense. And you guys working on the TNT desks can look at this and try and make the valuations add up, but I can't make the numbers add up. So I wish you the best of luck. So it feels to me a little bit like the markets have become immune to valuations as a reason to implode. So I don't think that's going to work. So that brings us to the sort of other two aspects. Does it implode because of its own weight, or does it implode because the Fed decide to poke it? Now, again, the market took the commentary from Walsh as fairly hawkish. I will say, having gone through the narrative a little bit, I don't know if it's as hawkish as everybody thinks it's going to be. In that, for example, like the Fed's balance sheet is still expanding and there's little that Walsh can do about that. And even if he were to increase interest rates, one of the things I'm worried about with this financial market is that, and I don't know how deep down the rabbit hole you want to go with this, Ethan, but I'm going to go with it anyway. Pre-2000, what typically used to happen was the real economy would influence the stock market. And the reason that happened was because the stock market looked and felt a lot like the real economy. There were industrials in there were banks in there was oil and gas in there. And as a fraction of the overall economy, it was still quite small, right? Like it wasn't a particularly big proportion. What has happened over the last, say, 20 odd years is that we've moved from that to a very different market. The financial markets are now so large that the financial markets influence the real economy, not the other way around. What that means is that the ability of the Federal Reserve to actually influence the stock market by slowing economic conditions and therefore popping the bubble is limited, and maybe is entirely gone away altogether. That may be the genuine thing that we're dealing with, is that markets have become immune to what's happening into the real economy. And I include, for example, the Fed in that. And if you want a little bit of evidence of this, take a look at what happened with the markets dealing with this oil spike. Oil underwent one of its biggest shocks since the 1970s, and the market effectively shrugged it off, right? So just to support my point, the market seems to be immune to conditions in the real economy. So again, the Fed's ability to pop that bubble seems limited. So therefore, we arrive at this third option, which is the only way this ends is if something goes wrong inside the bubble. So in many respects, the only way to kill this asset bubble, the Fed can't kill it. You're not going to kill it with expensive valuations. The only way it dies is through suicide, effectively, right? That's the only way this thing comes to an end. And so what does that suicide look like? Not to get too dark and morbid here for a second. What does that look like? Something like earnings not adding up, something like accountancy challenges or outright fraud, or that the AI investments, we've oversupplied in AI investments, and in fact there's very little demand or not enough demand to justify the investments. Does that make sense? That is the only way I think this thing ends. I don't think the Fed trying to do another sort of moving from 0 increase rates to 1 increase rate is not going to do anything. This thing has lost control. The only way this thing ends up collapsing is by collapsing in on itself. Does that make sense, Ethan?
Yeah. Thank you very much.
Yeah, kind of on that topic, specifically about accounting and the kind of valuations of these big tech companies. How do you think they can be made more realistic? Because that's kind of, I would argue, and I think you've written, written about this in Financial Fables. That's one of the huge problems here, is that it's hard to actually see what's kind of
this is difficult. Like the problem with accountancy, as soon as I start talking about accountancy rules, everybody's eyes glaze over and they fall asleep, which is exactly, for the most part, how accountants would like it to be, right? Like they don't really want you prodding and poking at their assumptions. The challenge with how these valuations are done, like there's a lot of problems, I wouldn't call them red flags, because red flags imply like outright fraud, but there's a lot of yellow flags going on with how you account for a lot of these tech investments. So just to give a couple of examples, like for one of the things we're seeing. Oh, I lost Ethan. Shall I keep going, Marcus?
Oh,
he's coming.
Yeah,
I'll keep going. So one of the things that we see, one of the challenges we get is, for example, we've got companies like Google and Amazon owning Anthropic. And one of the biggest movements for those companies' earnings over the last few quarters has been marking up Anthropic's overall private valuation. Anthropic's a private company. The only way to sort of mark that up is through seeing new capital raises into the company. Now, that's not necessarily a problem, but it counts for a huge proportion of these companies' earnings. And let's be clear, these are unrealized earnings. Anthropic hasn't floated. It's not actually recognized those earnings in public markets yet. So they're doing quite aggressive accountancy procedures here. Similarly, like you can see it with OpenAI. OpenAI's earnings were leaked a couple of weeks ago for 2025. And again, how the company is accounting for various items is a little bit challenging. First off, the sheer size of the losses should be a real warning to people. The headline loss for Anthropic is that they lost about 35 billion in one year. That's the same amount as what Uber lost in 8 years of operation before they started to turn a profit. So the scale of OpenAI's loss making is significant. Now, tech companies make losses before they turn profit. That everybody will tell you that. That's absolutely fair. You guys work on the TNT debt. You'll see this big sort of investment, years and years of losses, and then it comes good, right? The problem is that 35 billion is a damn big hole to dig yourself out of. The other element is that 35 billion is a bit of an understatement. The reason being is that what they've done is they've used an accountancy procedure where they've said, well, actually, some of these losses are going to be absorbed by another parent corporation that own us. And they've therefore transferred somewhere in the region of about 21 billion off balance sheet to someone else. I don't know who that is. I don't have the full OpenAI records. They're not publicly available, but that's 21 billion of losses that they've just gone. That's somebody else's problem. So in reality, the scale of OpenAI's losses in 2025 realistically were closer to 60 billion, not the 35 that we're talking about. So the numbers start to become mind-bogglingly large here. All of this is happening in the dark. Where a lot of this money is going, who knows? And I'm therefore a little bit concerned. How do I improve it? Well, the best thing would be for these companies to start, private companies to start releasing their earnings publicly, even though that they don't float publicly. They don't want to do that, and for good reason, because they've got sitting on significant losses. I wouldn't want to come out and say it either, because it will jeopardize my next capital raise. But for me personally, when I'm looking at these numbers, they don't fill me with joy. Can they be made to be more realistic? To answer your question, Marcus, yes, probably. But at this stage, trying to fix it now is going to be very difficult, because trying to change accountancy standards is hard work. Does that make sense?
Yeah, absolutely.
And kind of on the topic of massive spending, with the hyperscalers in particular, companies like Micron producing HBM memory with like 85%, I think, was their latest figure for their markup.
Yeah.
Their capex on memory alone has risen to 30% of total spending, and that's just on a single part of their AI infrastructure.
Oof.
And it's predicted to rise further next year. So do you think if this spending becomes like a non-cyclical thing, do you think that these hyperscalers can justify that as like a long-term thing?
Every technological innovation that has ever happened typically is characterized by lots of hype in the financial markets, bubble, then collapse, then the infrastructure makes sense. Okay. I look at the internet era as a prime example. Lots of investment into the internet, nothing on the scale that we're seeing of AI, by the way, but a lot of investment into the internet. Bubble expands, people's excitement gets ahead of themselves, it pops. The internet's still good. It's a transformatory technology. It just didn't realize the gains on the timeline that markets needed to. If you want an older example of that, guys, go and look at the railway bubbles in the United States. The same concept. Loads of investment, loads of railway construction. Everybody's buying railway stock. The bubble pops. Railway is still there. Like the underlying railway network is still there. And transformatory for America's industrial revolution, it just didn't get delivered on the timeline that the financial markets needed it. And that's what I think we're seeing with AI. I think it's an amazing technology. I use it a lot. I do not think it's going to deliver on the promises in the time frame that the financial markets require it to. That's my honest truth. Will it come good in 5-10 years? Yeah, absolutely. Do I think it will reshape the labor force? Absolutely. But the question for you guys as investors is, will this come good on the timeline that you need it to? And my gut feeling says no. But again, very easy for me on the sidelines as an economist to make that call. Much harder to be in the markets with the mental burden of having to keep up with peers and competitors to pull away from this. Does that make sense?
Yeah, thank you.
And then kind of shifting more to what's very recently happened with Fable and Anthropic. So I'm correct me if I'm wrong, but their valuation at one point was they were, arguing near $1 trillion.
Yeah, I understand.
How do you think their kind of valuation? How does their value change now that they had to shelve that?
So it's hard, right? Like, these companies are not easy to value. Like that, in terms of the transformatory power, it's difficult. So, at least when I was looking at SpaceX, I could look at a proposal and say, okay, well, roughly how much is this and this, and you can sort of, and the way SpaceX is structured is it's quite a few different sort of individual companies within it. So it's relatively easy to try and break it down and build up something that you can value. Anthropic is difficult to do because it doesn't have that structure. Plus, it's very into the AI trade. The challenge is that my personal view is that the valuation looks and feels high just based on prior tech numbers and IPOs that have come to market. Like the valuation of trading is insane. You highlight Fable markets, which I think is interesting, and it brings into focus a couple of points really. Firstly, I know very little about technology around the back end technology around AI. But what I do know is around how businesses operate and how industries end up evolving. AI to me looks and feels like a winner takes all sort of situation. Okay. I think that one name is going to probably end up dominating in particular spheres. Claude is particularly good for research and another one is particularly good for images. But what I will say is that once the infrastructure is in place, the ability to actually build a moat and protect yourself is potentially quite limited. Like there are new technologies, for example, that are coming on board, which sit above the AI platforms. And what they're going to do is they're essentially going to route the requests to lots of different AIs, bring it back to you and say, well, Claude says this, ChatGPT says this, Gemini or Copilot says this. Like, so you end up getting it sourced from lots of different places. Well, at that point, you've not, like, as Warren Buffett would talk about, there's no industry moat here. There's no way to protect yourself and to drive up costs. So that's one thing I'll say. So I worry a little bit about that. The second thing about Fable in particular is that it brings into focus some of the antitrust aspects that will come out of this, right? If AI starts to become dangerous, lawmakers will get involved. And that starts to change your picture very quickly. If you start getting slapped with national security concerns, then you're not going to be able to unlock the full potential of some of your projects. So again, I think that's an element that's changing. The long story short here, I'm really struggling to see how a name ends up being a dominant power in the AI industry to the point where it can start driving up costs. And the other thing is, as soon as they think, like, Anthropic may have the best thing now, but none of us on this call, nobody listening, can guarantee that someone somewhere in their garage perhaps has developed the new next generation of AI, right? And suddenly Anthropic's lost all of its value and things have started to change. This is my problem. I'm struggling to be able to identify the moat around which AI is going to be able to protect itself, drive up the margins, and ultimately repay the debt that it's taken out, right, guys? That's the problem. Maybe I'm wrong, and I'm genuinely interested. If there is a way of building a moat to protect this and increase your prices, then I'd love to know, but I can't see it at the moment. Does that make sense?
Yeah, absolutely. And I also kind of wanted to follow that up with recently what has been looking like one of the best investments out of the big kind of tech corporations is Apple, which I didn't think I'd be saying at a certain point, because they were, with Apple Intelligence, they were just trailing behind. But I think what I've seen from them, not only do they have the old, head of hardware now as the CEO, they also have the chief hardware officer. So it's a very kind of hardware direction. And I think Apple, as the company which facilitates people using AI, I see all over TikTok and Instagram, joke like memes about startup founders who are all about AI, but it's always about how they buy a MacBook and then have Claude. So I think for me, it's providing the infrastructure for consumers, and that's why all of these corporations where maybe not 3 months ago, but 6 months ago, I would have said Gemini, use that 100%. Don't bother with ChatGPT. Don't bother with Claude. I would have just said Gemini. Now I'd only say Claude. It's like, whereas I know I'd use my iPad for all of that. So that's kind of what I think is the best way to kind of maybe.
And it's interesting you flag Apple, because when you're looking at companies, if you, Marcus, if you and I had talked a couple of years ago, I would have talked to you about the Mag 7, like the Magnificent Seven stocks. And one of the reasons I love them was that their balance sheets were just so good. Like there was, you're sitting on huge cash piles. Your debt stock is close to zero. You're sitting right at the forefront of tech innovation. Like any new company that was coming up, these guys were just buying and incorporating it into their setup. And AI, to a certain extent, has ruined that Mag 7 trade, because you take Google or Meta's or Amazon's balance sheet now, the share buybacks are falling, the debt raises are large. Meta's, in fact, thinking about doing an equity raise, issuing new shares. Just to put that in perspective, Jeff, if a company is issuing new stock, that means you've run out of other sources of money. That's a pretty expensive thing to be doing, because existing shareholders will not like it. So the fact that you're seeing these companies leaning towards it, Meta are looking at quite a large one, just to chuck it into catching up in AI, I don't like that very much. But Marcus, you highlight Apple. Apple haven't. They're involved in it, but I think involved in the AI in a much more cautious manner.
Yeah.
I haven't seen the balance sheet quality erosion that so many other firms have had. I quite like Apple, but again, this is as far as I will go into venturing into your realms of stock picking, because that's it is not my area of expertise by any stretch.
Fair enough. Absolutely. Thank you.
Do we have time for one more question? Or?
You can keep going, Jeff. You tell me when you want to cap
Okay, perfect. On a slightly different topic, a more macro kind of view, it's looking likely that Andy Burnham, I'm sure you've got this question a few times this week as well. Andy Burnham will be our next Prime Minister, and a lot of his policies are very high spending. But given the kind of past 5 years we've had, where we've had immense spending during COVID, and we're having to pay that back now, do you think we have the fiscal headroom to start doing more spending, or we need to instead be paying back our current debts?
So solving a fiscal burden is not particularly difficult. Like the thing about it is that there are really only two ways to solve a debt to GDP ratio that the UK, many other European and US face as well. On that point, I'm a little cautious about comparing the United States to Europe. The US has the ability to print the world's reserve currency. It has powers beyond our means. So like maybe put that as a side discussion. For European nations, you're in a tough bind, because there are two ways out, and history has provided this before. We've seen big instances here in the UK where we've had debt to GDPs at very high levels. How do we solve it previously? So I'll take you back on a bit of an economic history talk, but the first point that we were facing really high debt to GDP ratios was at the end of the Napoleonic Wars in the early 1800s. The UK had done a lot had fought a lot of wars with Napoleon to try and stop the spread of France and to check their power, both in Europe and internationally. And the country was on the brink of financial ruin. The agreement then, the solution was that both sides of the political spectrum agreed that this was indeed a serious problem. And therefore, all of them agreed that whoever was in power, they would run budget surpluses consistently in order to pay down the debt. And the debt to GDP ratio fell from around sort of, if I've got my numbers right, close to 200% in the early 1800s, and got down all the way to 25% by just before World War I. So huge progress. And so brought on by political cooperation. Didn't matter who was in power. The agreement was you run a budget surplus. Now, fast forward to the end of World War II, UK finds itself in a very familiar spot. War debt has driven up debt to GDP ratios, this time to about 150, if I remember correctly. How did they get out of it this time? This time it was growth. What we saw happen was significant growth following the Marshall Plan. We also saw financial repression, where there was sort of interest rate caps involved. The other thing we shouldn't forget, however, is that also there was a very large boost to growth in the form of women entering into the workforce. For a long period of time, GDP was essentially constrained because about half the workforce stayed at home, and we don't capture GDP figures that reflect home working. So those women coming from the home, going into work, suddenly there's a massive expansion of GDP growth as well. So a lot of these factors then meant that we just simply outran our debt to GDP ratios, right? So they're the two ways out. There isn't a magical third way, I'm afraid. I throw the question to you guys. Do any of them seem particularly likely to you at the moment? Yeah, didn't think so.
Hopeful.
No, yeah, hopeful. And so this is where we arrive at, right? Like, this is the problems that Andy Burnham faces. And not to go too far down the political rabbit hole here, I don't understand what he's going to do differently to the same constraints that not just his predecessor, but Starmer's predecessors faced, in that you're inheriting a large budget deficit and there are tough decisions to be made. You can't get political agreement across the spectrum to do this. And on top of that, you don't have a magical sort of a solution to bolster growth. We've got an aging population that's quickly growing. It's hard to do. Perhaps the AI investment will come good and productivity will boom because of it. Maybe that's the way out, but that feels like a real moonshot hope to me. So what I think will end up happening is that Burnham can promise the world, but when he gets into power, he may end up getting slapped around by the bond market because bonds will just freak out. And at that point, your economic credibility is questioned. At that point, Labour start to lose goodwill, markets start to freak out. Either one of two things will happen. Either the markets will put them back or they'll keep trying to push and something will break. Either way, I don't think it is a particularly pretty outcome. The other element, just to think about this, is that even if Burnham comes in and he steps into number 10 and the scales fall from his eyes and he adopts an entirely different economic mantra and he says, I'm going to fix this fiscal deficit. Think about the austerity that's going to be required, the changes that are going to be made. Labour will lose the next election if they do that. They may lose it anyway, but they'll definitely lose it if they adopt those policies, because it will probably hit their voter base. And all they'd be doing is handing a clean fiscal book to the Reform Party to spend. Why would I want to do that if I was a Labour MP? I don't want to help Reform out by giving them a clean bill of health and fixing these financial problems. I'm going to throw the problem at them. And so you can see immediately as well, you know, if you've done your economics, there's the Nash equilibrium here. The Nash equilibrium is that we just keep spending money we don't have because politicians are just too short-sighted to fix it. That's the problem, champs. And that's why I don't have much faith in the UK fiscal outlook at the moment, unfortunately.
It seems to either be displeased the bond markets or displeased voters.
Exactly. And this is where the problem is that there needs to be a better, you know, if I were a politician, there needs to be a better communication from politicians about the scale of this budget deficit and the problems. That's the issue, is people don't understand it. They're very short-sighted and they care a lot about the here and now. There's very little thought about, okay, how do we solve this so that my children have a better future? That doesn't seem to be part of the discussion at all at the moment. It's about what can I make now? So what I would be trying to do as a politician is try to quantify the numbers that we're talking about here. For example, take a look at the interest expense that we're spending now. It's becoming the single biggest item on the government's expenditure every year. Tell me how many nurses that's going to pay for. Tell me how many firemen that's going to pay for. Show people what the costs are in real terms that they understand of this debt, and maybe the conversation begins to change. But right now, politicians end up getting slapped around if they try and do anything that looks like austerity or looks like trying to balance the budgets. Does that make sense?
Yeah.
Cool.
Yeah.
How are we doing on time? Marcus, you tell me. You want to do one or two more?
Oh, I've got one question just
You do
about,
it.
yeah. So I attended London Tech Week a few weeks ago.
Nice.
And the number one thing that was talked about wasn't, kind of uh, spending or this or that. It was about sovereign AI. And I was curious about, whether how you thought kind of a move towards more sovereign AI would affect, the huge American AI companies.
So sorry, you crackled just at the point. Sovereign,
Sorry.
that countries have their own.
Yeah, exactly. It's the kind of the full stack idea where it's um, pretty much the infrastructure managed by a country, the data held within the country. How does that kind of, because it's such an interesting thing, and I didn't really expect that to be the thing the most talked about. But one example was,
So a couple of.
Yeah, sorry. I'll let you speak.
What was the example? What was the example at London Tech Week?
Just
I'm
about
interested.
it was Finland had actually run out of their language to train their AI model. So they've started and they've had to digitize all of their language, and it's quite a testament to how much countries are going in this direction.
That's a great. I didn't know that about Finland. It doesn't surprise me though, right? Like these AI models, the amount of and Finnish is a tricky old language to learn. Look, I think the sovereignty story. Like there are lots of. It's a very interesting theoretical discussion, right? Like that essentially that an AI should stay within its potential sort of geographical boundaries. The problem I have is that I just frankly don't believe that it's possible. If you want to take a look at how hard this is, go and look at the spread of cryptocurrencies. They have not stayed anywhere remotely close to national boundaries, and the tech community as a whole. Again, I'm speaking very broadly. The tech community as a whole tend to be fairly anti-establishmentarians, right? Like they don't. There doesn't seem to be a spirit around national sovereignty embedded in many of these tech firms and these overall tech entrepreneurs. They tend to be big dreamers. They spend a large amount of time looking at the sky for various reasons, and they don't seem to sort of respect international boundaries, laws, or norms all that much. So the idea that AI, and the only way that national sovereignty within AI takes any form is if those tech entrepreneurs, those tech developers actually start thinking about the world in that manner. And I just don't think it's going to happen. I think what will end up happening, like with so many tech revolutions, the government officials are behind the curve. They don't understand. You may recall, for example, there was a discussion in the US Senate around 5G implementation. There were worries about China backdooring its way into US 5G networks. And there was an open session where they brought in various CEO leaders, and it became bloody apparent within a few minutes that these senators had no clue how 5G worked, or in fact how anything tech related worked. And if they're the ones that are meant to be shaping the rules, how the heck can you keep up with AI? Because I don't think you can. Now, let's say they are able to pass rules and they're able to get everybody on board, and that this sort of works. And perhaps maybe with some of the sanctioning of Fable and other things, maybe the US politicians can for once be ahead of the game. If that's the case, then Europe and the UK are woefully underinvested in the data infrastructure trend and building of data centers. If that does happen, there needs to be a whole load of reinvestment here in the UK and Europe. A lot of people that seems to be like the thing that people are hanging on to is like the next wave of this, that Europe and the UK will play catch up and you're going to see some serious data center investment. Again, I'm very skeptical of that. Like Europe are not quick on technical innovation. And the other challenge that we have in Europe is that, and particularly in the UK, is that all of those data centers get set up. We have a very, very archaic approval process for building new infrastructure like that. You want to build a big ass data center in someone's back garden, immediately local residents are going to petition and get it blocked. Look at how long it took us to build a goddamn railway and we didn't even make it to our end destination, right? Imagine what happens when you start popping data centers into people's back gardens. It's just not going to happen. So I think there's 2 points. There's the political element of this about trying to put guardrails around from a legal perspective so that AI respects national boundaries. I don't think that's going to happen. The next level of that is that tech developers need to start thinking about it in a national. They don't think about it in that way at all. So there's a problem there. And then the third is, even if you were to get the tech community and the political community to get together and think about this in the right way, the logistics of playing catch up with infrastructure in the UK and Europe, I just can't see happening. Does that make sense? So no, in short, I think it's a nice idea. People kick it around, but can't see it happening.
I think that's, and also another thing is, one example is with the Fable launch, part of the reason why they had to take it down, I saw an article on this, that they were asked to only have access for American citizens, which is just like obviously an kind of an impossible thing to make sure within an hour or however long it was.
How are you going to do that with? Exactly. How are you going to do it with VPN access? Like, just my first thought is
exactly, but it's just it goes to show that there's so little kind of
you see it with the UK. Like, and not to get too crude on this call, but you've seen it with the UK trying to block like pornography websites, for example. Whoever came up with that rule, you clearly don't understand how the internet works, because all that happened the next day was a spike in VPN downloads. Like,
exactly.
Come on, guys. Like, this is. I think the sad thing is that frankly, when it comes to getting tech to respect national boundaries, you're playing a game of whack-a-mole. It is honestly the honest truth. And so any attempt, I think, frankly, it's a waste of time to try and sort of keep AI inside boundaries. I think it's just, there are better things for us to be trying to do and to police than running around trying to solve that one.
Absolutely.
Does that make sense?
Yeah, 100%. No, I think that's excellent. That's great. That should be, I'll edit that down. And then, sorry, I thought I was looking a lot at the second
bits that you want to cut, Marcus. You get it to what you wanted to go for. All right, chaps. Absolute pleasure. Nice speaking with you.
Thank you.
Thanks very much for your time.